I think it's time to dive into the content. This is why you're here, and I'm really glad to have to onboard on stage Simon Torrance. So Simon is the founder and CEO of Embedded Finance and Super App Strategies. He's also the co-author of this great book that I recommend called Fight Back. About slow growth, no growth, digital disruption, question mark, what to do with that, and how to win the digital economy with platforms, ventures, and entrepreneur. So let's have Simon on stage and share his content with us. Hello, Simon. How are you?
Very well, Mehdi. Very lovely to be back here with you today.
Yeah, again, a lot of people loved your content last year, and the goal is really for Apidays London 2020, and the goal is really to have a kind of an update to what really changed, and is the opportunity still there for embedded finance? You will tell us that. I invite you to share your screen with us. Yeah, it's full screen and it's perfectly readable. The stage is yours for 30 minutes, and we will be back for questions. And again, just for everybody, you can ask a question directly on the platform, on the side chat. You can ask directly question. I would be glad to ask these questions to Simon at the end of the talk. Enjoy, Simon.
Thank you very much, Mehdi. Yes, so I'm going to talk about embedded finance and why it is a $7.2 trillion market opportunity for those who can enable it. It's one of the biggest trends in finance, and it's essentially about helping other businesses to be more successful. So Mehdi has already very kindly introduced myself. The book it says Fight Back. It was originally about how traditional companies can fight back against digital disruption, but really it's also about how they can fight back against old ways of thinking and old ways of acting, which tend to hold back traditional companies from being able to play an effective role in the digital economy. But let me start by the problem that embedded finance is addressing. And to not put it too bluntly, I would say that our financial system is not fit for purpose. And I'll give you two examples here that bring this to life. We as humanity cannot afford to retire. The gap between the amount of savings that we need overall and what we are likely to have is very, very wide indeed. It's in the trillions of dollars. And that is a problem that is building up for all of us as we get older and older and live longer. And so just on that one simple area of financial services, savings and having enough to retire on, we can see there is a huge gap. If I take another example, a survey in the US of consumers about their satisfaction with banks. On one side, it looks really quite good. 86% of them were satisfied or very satisfied with their current bank, but only at dealing with 1% of their financial wellness needs. Certainly a bank is a very good place to keep your money safe, but is it helping you to plan for the future, to understand and manage debt, to make big decisions about purchases, to plan for your retirement? Well, those are the things that consumers say they are really important to them, but the current suppliers are not helping them with that. And that's where, of course, a lot of startups are starting to play. But that big white space you see on the right is the gap and the opportunity for it to be filled. So at one level, as consumers, we're not being well supported by the industry. On the other side, as an industry trying to support customers, we're not making any money. So this chart shows the economic profit of, on average, of the top players in various sectors. And economic profit is the measure of profit after cost of capital. And it's a very pure measure of profit. It says, you know, if we invest our money in this type of activity, this is the returns we get. And what you can see here is that banking, even before the pandemic, on average, banks were making negative economic profit. That means that where they were placing their bets was not making a return. And due to digitization, that is due to get even worse, because digitization creates more competition, more transparency, it raises customer expectations. Sometimes it introduces new regulations like open banking. And that's the same for insurance as well. And we know that that's partly due to low interest rates, but all kinds of other things where the traditional financial service industry hasn't really leapt ahead to take advantage of digitization enough. Of course, there's one sector that is doing extremely well and will do even better in the future, which is software-based businesses, because that's the nature and underpinning of digitization. But there are some financial institutions that have embraced software, and those ones, you can see their logos on the top there. They're doing extremely well compared to the traditional incumbents. And you have companies like Stripe and Square, and Klarna would be another good example, which are now worth more than traditional financial institutions. And as a result, the CEO of JP Morgan, today, I think the biggest bank in the world, says he is rather worried about this chart. How do we as a financial institution, even the biggest in the world like his, how do we change our business models to be fit for the future, to be able to support customers with their real needs into the future? And the third problem is the one about our customers are changing. We are soon millennials and Generation Z are going to make up the greatest proportion of the workforce and be the most economically powerful group in the economy. And our propositions and our ways of interacting with customers are not designed for this new cohort. In fact, in general, people are spending more and more time on their mobile phones within mobile apps. And this chart below on the left is not for millennials. It's on average in different countries. People are spending 3 to 5 hours per day inside mobile apps. And again, how do we play a role in that that is beyond just creating our own app that no one ever comes to? And at the same time, we think we've got a handle on new distribution channels or channels of engagement like Facebook and Twitter and Instagram and so on. But innovation is happening so fast that new platforms are emerging. TikTok didn't exist a few years ago, and now it has over 1 billion users. So we've got all these things merging together, which are making it very difficult for companies to be successful in this world. And we need to understand what types of business models actually work and are most powerful in a digital world. And I did some work with the World Economic Forum earlier on this year to look at and try to create a taxonomy for the types of digital business models that exist and which are most powerful. And the problem for most incumbent organizations is they spend 99% of their effort digitizing their existing business model, trying to create an app, trying to maybe automate some of their processes. But that is essentially optimizing a business model which isn't very profitable as it is. So that's okay, and it's necessary, certainly. But where companies need to move to, as well as doing that, is to into some of these other business models. And I'll just lay them out to you, and I've put a few examples to bring it to life. And these are examples from outside of financial services and inside different aspects of financial service. So intelligent solutions are those that are solving problems that existing propositions don't do. They're using artificial intelligence and digital technology in new ways to address friction that exists. And in our world of financial services, Klarna is a golden example. It sounds very simple to buy now, pay later, but the way they do it and the way they've made it very easy for other companies to embed that into their end user experience means that they are now currently worth 50% more than Deutsche Bank. Now, you have some traditional in financial institutions that are fighting back and creating their own intelligent solutions, like Marcus from Goldman Sachs, which has been hugely successful. And in the insurance space, iptiQ from Swiss Re, which is a digital business and intelligent solution for embedded insurance. And that's proving very successful. But this other layer, the number 3, developer enablement, is really key as well, because developers are the new kingmakers. Indeed, Goldman Sachs says that developers are our new customers. These are the people who are developing intelligent digital solutions for other brands, that's big and small around the world. And in the telco world, Twilio was hugely successful, enabling people to embed messaging and communications into their propositions. And we know how successful Stripe has been. And we're starting to see the same in insurance. And indeed, Goldman Sachs, even its transaction business, has now created a developer platform called TXB. Online marketplaces are extremely powerful because they are asset light. You don't have to produce any products to make money out of products. And in the classic world of eBay, and we know Airbnb, how successful they've been. In our world, Money Supermarket has been successful, price comparison sites as well. But these are quite different. These are difficult businesses to get to scale. The ultimate business model is when you orchestrate a whole ecosystem of your own products, intelligent solutions, you're enabling developers, you're creating marketplaces. And that's what the companies on the top have been able to do with enormous success. And so far, most incumbent businesses are stuck at around 1, trying to get into number 2. And my contention is they need to be bolder at creating new business models that will suit the world that we're moving into. And later on, I'll talk about how that could work. Now, open banking helps to enable all of this. It's a stimulant for innovation. Embedded finance cuts across all of these business models. It has a role in enabling all of them. So let me try and define it for you now. So embedded finance, as I said, is one of the biggest trends in the financial service sector at the moment. And this definition I find most useful. Essentially, it's about abstracting financial service functionality into technology so that any product or service provider or any developer at any company can very easily integrate financial service propositions into their own end user experiences. So I'll give you a few examples of that, and then we'll go into more details about why this is attractive for these brands and what it means to, and later on I'll share with you a really interesting use case as well. But there are 2 types of embedded finance. One where it's an add-on that is visible and complementary to your existing proposition. So a very good example is buy now, pay later at point of sale. It's a visible add-on. It helps to convert a sale. It could be, for example, also Starbucks coffee. They have a digital wallet and you can store value on that wallet and you use it when you go and buy a coffee, and they've automated the process of you turn up, your coffee's ready, it's been paid, and you don't have to worry about it. Now, that's very attractive for customers. It makes things easy for them. It's also very attractive for Starbucks because they essentially, we who use that are lending Starbucks our money. I think there's about $2 billion of float in Starbucks wallets, which is essentially us giving an interest-free loan to Starbucks to use as they wish. So a visible complementary add-on. Shopify is also an example where Shopify runs a platform for lots of small businesses to create a shop front, and it makes 50% of its revenue now from financial services, payment services, lending services, and increasingly insurance. Now, the other aspect of embedded finance is it's completely invisible. It's just a component of the proposition and experience that the brand is creating. And again, the classic example is Uber. They have embedded payments into their experience. So I don't have to get my credit card out when I want to pay the driver. The driver also has insurance embedded within its service contract with Uber. So the idea is that these brands you see on the right, they have more regular interaction with customers. They know more about their interests than financial institutions, and therefore, in theory, they're in a better position and they're at the right moment to be able to either offer financial services or have that as part of their proposition. And a really good example of this is Intuit QuickBooks. QuickBooks is an accounting software system that many businesses use to run their operations. Now, QuickBooks actually knows when you might need a loan or might need insurance before you do. It can see when you're hiring more people. It can see where when you're expanding. It can see that you've got more invoices going out that need chasing, and it can trigger the offer of financial services before the customer even realizes. And that's very different from the traditional relationship with a bank or insurance company, where the customer has to think about, well, I might need a loan now, I might need insurance, I'm going to call up a broker or call up the bank. All of that friction is collapsed because the ability to access the relevant type of financial solution can be made by a company that's much closer to the end customer than the financial institution. And so we're looking at moving to much more timely, personalized, and relevant embedding of financial services, which ultimately create for brands much better customer experiences if they can get it right. And indeed, much cheaper, much fairer financial services than you can get through the traditional system. If you're someone who is poor or has bad credit history, you're almost locked out of the financial system, and it has a very big impact on financial inclusion as well. Data is the key enabler of this. It's not just the data of the brands themselves that they have on customers, but the ability to access open banking data is really key as well. So let's give you a few tangible commercial examples of why this is attractive. If you are selling B2B software that businesses run their operations on, then it costs you virtually nothing to offer payments, loans, and insurance. That you've already acquired your customers with your software, and it's very, very high margin then to offer these services, which are now being made available by parties that enable this. And you can increase your addressable market or the total revenue you make from your clients by a very significant amount. If you are a retailer and manufacturer, the ability to increase the order value by adding payment terms or indeed insurance at point of sale can be very significant. And the ability to increase the conversion rate when people are about to buy something, it's a bit too expensive, but I can spread the payments at that point, and it's a click of a couple of buttons, then it leads to greater conversion. And in terms of inclusion, creating new markets that didn't exist before, this example on the right is very instructive, how the world is likely to move. And this is where digital platforms, like in this case, Alipay in China, have daily interactions with millions of customers. Everybody uses Alipay to pay for things. Alipay has a whole set of other services wrapped around it, and it's an essential part of people's daily lives. So in rural China, there are hundreds of millions of people that have no insurance, for example. I mean, they also don't have access to credit very, very well. But in terms of insurance, what Alipay and Ant Group do is that they have decided to act as an intermediary, almost orchestrate a marketplace whereby they educate and engage their customers about insurance, making it understandable when before it wasn't. They then work with a network of 90 insurance companies to design the right type of products that will suit those customers, that are affordable, that are relevant, that are personalized. And because Alipay is managing a marketplace where people are competing for that business, they're able to offer incredibly affordable life insurance, critical illness insurance, really important types of protection that in the past were never available to this audience. And my contention is that model will come to the West as well, and we can include so many more people in having the right level of protection or the right level of credit or the right level of other financial wellness products into the future. So in terms of the size of the market, if you look at it, started with payments, which of course is less regulated than other aspects of financial services. And we started to see the emergence of businesses that were enabling other businesses to offer payments and make money out of it, rather than payments being a cost to their business. And if you look at the trends over the last few years and extrapolate forwards, this is from the US, and then you can extrapolate it globally with different trend lines. You can see that the proportion of financial services which are distributed in an embedded way, i.e. through third parties enabled by software, is going to become quite significant. And in payments, we might say in the US, it will be about 40%. In lending, we might say about 20%, insurance 20% in the next 10 years. In other parts of the world, it'll be slower. But if you add up all those figures, you get to a very significant amount. And of course, the companies that are enabling this are software companies. They are leveraging financial technology. And therefore, even just at a multiple of 5 times revenue, the businesses which are enabling embedded finance could be worth something in the region of $7.2 trillion in 10 years' time. It might be 15 years, it might be 20 years, but the point here is that this is an order of magnitude. To put it in perspective, that figure is double the total value of the top 30 global financial institutions today, and about 50% more than the top 30 global software companies. So what's happening now, and I'm sure many people in this audience are part of this movement, is that there are new businesses that are being built on top of the enormous developments in financial technology. Just as in the past, businesses became famous on the back of the internet itself in terms of leveraged cloud technology and mobile technology. And so financial technology is becoming the world's new innovation platform, creating the ability for embedded finance to take off. So let's just look at what's happening here. And you can see the traditional method of distribution of financial services that has existed for many years now. And it's very product centric. We, or banks and insurance companies, create products, they do the underwriting, and they sell those products through different channels. Now, what's happening now is that we're seeing the fragmentation and modularization of that, with new players entering the market. And in principle now, any type of product can be bundled together with any other type of component from any source. And this typically is being done by this new layer of what I call developer platforms or neo aggregators. And it's an early, some people call this embedded finance infrastructure. It's still in the early days of maturity. But what we're seeing now is that this new layer is able to take these modularized components from any source and help other businesses configure them to suit the needs of their customers. And those other businesses, initially it started with fintechs and big techs, but now any company, whether it's a retailer, a telco, a utility, or a bank itself, can potentially, with the enablement of this platform in the middle, take these components and create those types of experiences that I described earlier on. Now, the digital wallet becomes the key, one of the key control points here. Customers will have digital wallets from many different brands that they work with, and they will be able to get now much more personalized, affordable, and compelling solutions to their problems. Not products, but solutions to their problems, which are integrated into their daily lives, not something they have to think about separately and ring up to get support for. And those companies that understand their daily lives and support those daily lives, the brands that they interact with on a regular basis through digital wallets and other apps, will be the ones that succeed in this marketplace. So I'm going to give you a quick use case before I finish. And I'm spending a lot of time with traditional brands in different sectors, helping them to think about how they could become a super app. And I'm not suggesting they are ever going to become like WeChat or Alipay. Those are very super, they're mega apps. But the notion here is, how do we create an environment that has more engagement with our customers, that allows them to spend more of their time and more of their money with us? Because most apps from most brands are very, very narrowly focused, and the engagement levels are not very high compared to some of the most digitally successful companies. And I'm going to share with you one little use case quickly in the next 5 minutes to stimulate how open banking is being used in a new innovative way, how embedded finance combines with that to help brands engage with their customers better. So here's a little scenario for you, which is something that this is a company I work with enables this, but here's how it might go. And we're going to take Boots, the chemist, which you may well know, as the example here. And Boots doesn't do this. I'm just using them as an example for the sake of illustration here. But Boots has a very simple app at the moment. You can shop on it. It's not that easy to do so. You can see how many loyalty points you've got. It's a pretty simple app. But now with embedded finance, you can turn that app into a wallet, and you can use it to make payments. And you can do this very cheaply and very quickly than you could have done in the past. What you do next is you make an incentive for your customers to link their bank accounts and their credit cards to your app and its wallet using open banking protocols. And the incentive essentially is this. It says, if you connect your bank accounts to our app, which is secure and safe, anywhere you spend in your daily life, we will give you free cash if you spend it with certain merchants. If you use our own virtual card to buy things, you'll get even more free cash. And free cash is probably the best hook and the best incentive for any consumer. And then suddenly you get instant cash into your wallet. It's not a point that you might redeem in 30 days' time and you're not quite sure how it works, but actual hard cash into a savings account in your wallet, which you have complete control of. Now, once you've done that, you're building up savings. So that's helping you with your financial wellness. That's part of Boots being much more closely interacting with you on a daily basis. You're now engaged with Boots, not just when you want to buy some cosmetics or pharmaceutical products. You're now thinking about Boots when you're buying things in Sainsbury's or you're buying things on Amazon. You're using your connected wallet to support those transactions, and you're getting a reward for doing what you already do. Now, this creates the hook for then Boots to increase the types of services that it offers. It can then start to offer you insurance and loans and other third-party digital services. You're hooked into a deeper and more useful experience with Boots, which is supporting you better in your daily life and helping you with your financial wellness. And for the Boots marketing managers, the beauty of this use case in terms of using open banking data is that you can see all the backdated transactions that the customer has done in the past. So you can make sure that the offers that you're integrating into here are relevant to them, and you have real-time insights based on real purchase behavior, not just guessing what people might be interested in by their demographics. You know what they spend their money on and how much they spend on different types of things, where they spend, and how old they are, and so on. You can see how your brand performs against others, and ultimately, you can, by making your app a payment mechanism, you can reduce your reliance on the card schemes. Now, what I've just showed you there is essentially, if you go back to my previous diagram, a brand like Boots becoming more of a super app. It's doing more for customers. It's supporting them in their daily life, and it's integrated there, and it's taking advantage of embedded finance infrastructure to enable that. And you can see the benefits on the right-hand side. These are things that are real, that we have many case studies from brands and retailers who are doing this now. But I think one of the key points here is that you are creating very, very important customers. You're focusing on them and supporting them, making them more engaged with you, so they spend more money with you and more time with you and share more of their data with you. And those customers, those 20% of your customers, deliver 80% of your profits. So this is about really getting deeply ingrained into the lives of your most important customers, creating more value for them, creating higher lifetime value. And because, as I mentioned, you're now engaged with them on a daily basis, the cost of acquisition for new services to them, either your own or third parties, are very, very low. And ultimately, you get a better business model, which is the thing that all companies are trying to achieve. So just to finish off, there's quite a lot there that I've shared. There's a lot of subtlety in that last use case, which I'd be delighted to discuss with anybody offline. But to make embedded finance work, whether you're a third-party brand or you're a bank or financial institution, you'll need to create a different organizational structure, because these types of business models are not something that can flourish within the core of a business which has been around for many decades and is all focused on the existing business model. You do need to optimize your core by creating APIs so you can participate in the digital world. You need to datafy everything you do and automate it. That's table stakes, but that's supporting your existing business model, which, as we know through digitization, is under increasing pressure. You need to create a separate space in which you can create your own ventures, either internal or external, collaborating with fintechs, to fast track the future and create the types of propositions or businesses I've just described. And you need to connect these together such that the future activity can leverage the assets of the core, and the core can be supported by the future, and the future can drive demand for the core. And getting that combination right is the key to a successful business model in the digital economy. Thank you very much. I hope this has been stimulating and useful.
Yeah, thank you very much, Simon. That was extremely great. We already have some questions, but I will just take the first one here. So you mentioned the term super app, like some people call it hyper app, like like the WeChat, where everything is embedded, right? The next user interface is just text at some point in this app, where payment and booking and retail and everything is embedded into that. But we can't have so many winners with super apps. It's winner takes all at this point. So how can companies be part of this? Should they accept to be embedded where they can't go and try to embed others? Should everybody try to be a super finance app or super app for their value proposition? So what is the trade-off between embed others or being embedded?
Yeah, it's a very good question. So there's two aspects of this. Essentially, you want to have more regular, as a brand, more regular high-value interactions with your customers. So whatever is going on in the rest of the world, you want to do that. You want to increase the lifetime value of your customers. So you're adding more value to your customers, and they're giving you their attention or their money in return. So that's the fundamental for any business, and you want to do it as cheaply as possible. So my point about Super App, and Super App, as you say, and I said as well, we're not trying to create, Alipay or WeChat that does everything for you, but every brand wants to have a deeper relationship with their customers. And what embedded finance and open banking does, it creates the glue to enable that. And payments is a really, and digital wallets are a really key aspect of that glue, because you buy things every day. And in the past, it was very difficult for brands to create their own credit card or debit card and so on. And they had to pay a lot of money to the card schemes for that. But now financial technology means that any company can do that really easily and really quickly. And if you can create an incentive for why you might use that payment mechanism, like the incentive I showed in that use case, then you've got a hook for customers to spend more time with you. And that means then you're in a position to expand the types of services you offer. So as the example with Boots isn't going to offer thousands of services, but it can go from offering a small number of products to a wider number of relevant digital services that meet the unmet needs of their customers. And their job is to define what that is. So what I'm saying is that suddenly they have that ability, whereas in the past, it was just too difficult and too complicated. And now every brand has that ability. So every brand can be a more powerful app. They're not going to be like WeChat, but they're going to be more powerful, and therefore their companies can be more successful. And if they do this well, they can beat their competition, they can get more customers, and they can grow the types of services that they offer. So that's the opportunity for all brands to be more engaged, to increase customer lifetime value at lower cost of customer acquisition, which is the key metric for success. And it also means that they can also, in this modular world, make their aspects of what they do embeddable in other people's propositions as well. So, there could be solutions that Boots create, which it offers, keeps to itself, but it could be they could also embed them into other people's propositions, into banking propositions as well. So you're quite right. There is this intermingling between what you do, connecting with others, but we're just at the early days of this. Most brands don't even realize what you can do now. And many retailers I work with, they've been selling loans and been selling insurance for some time, but they do it in a very analog way, and it's not very attractive. So those are the principles that I'm trying to suggest at the moment.
So it seems it's really about colonization of all customer experiences that on your own apps or other people apps. And we have a comment here about at one point you say developers are the new kingmakers, and so in that colonization aspect, with APIs that enable you other to onboard, to embed you, or you to embed others, are these developers the new settlers, the one that will help you colonize other people customer experiences? What needs to be the relationship from incumbents with the new developers community?
Well, it depends what type of incumbents. So if you are trying to distribute your products or solutions, the developers are your distributors. I think that's one point. So that's why Goldman Sachs says developers are our new customers, because we've got financial services and we want to embed them into other people's brands. So for Goldman Sachs, they are the new distributors, and they need to be treated like customers. They need to be, that means attracted. The value proposition has to be compelling. So that's quite a big shift for a company, an old, 150-year-old company like that, to say that. And they put that in their investor presentation. So it's really critical to think about developers as a new customer base. And of course, in the software world, this is, people have done this for a long time. But in the traditional industries, we haven't done that very well at all. And the second thing is the developers are your product developers as well, because developers are the ones who, like with Uber, they're the ones who design that wonderful experience of getting in and out of the car without you having to use your credit card. So they're the ones who are creating the experiences of customers. So they are both your key innovators, if you're a brand trying to create compelling experiences, and they're your customers if you have products that you're trying to distribute in a new way in a digital world.
So yeah, so you need developers in the company to build it, and developers outside the company to distribute and spread. Right? So developers all the way down. Definitely, we have a last comment about value accumulation. It seems that by doing network orchestration, at some point you are able to really orchestrate what others have built in innovative ways that enable to fulfill customer needs. Would you say that it's easier? We have more and more bigger giants, but it's more easier than ever to accumulate value over time by orchestrating the right APIs or the right value proposition?
Yeah, absolutely. So in the past, obviously Amazon has got a huge marketplace of suppliers, but that's because it decided that it was not going to try and do everything itself 20 years ago. And that was a big mental shift. Why we'll be cannibalizing ourselves? Why are we doing that? Now, we know that model works really well. The App Store is another good example from Apple. But now any company can do that because technologies enabled by APIs make it very easy now to plug in any third-party service to solve a problem for your customer. And you take a cut of that. You can orchestrate that experience as part of your super app strategy. So now, in the past, that was difficult to do. Technology is making it much easier to do, and vendors of products and services are desperate for new distribution channels. So all these things are coming together quite nicely to enable brands to create new experiences from customers without having to do all the work themselves. That's the critical thing. Leveraging the creativity and investments of others who've created solutions, being an intermediary between them and the needs of your customers, and be able to orchestrate that experience.
Yes, I think that was a lot of people are congratulating the content and the insights. We reached the time. Thank you very much, Simon. It was great to have you again, and we hope next year we'll be able to have you in a physical manner, right, for some live stage experience for that topic. Thank you very much, Simon. And yes, some people are asking. The video will be live in I think in 1 week on the YouTube channel of Apidays. Thank you again, Simon.